Something has changed to gold and silver, and the people who understand what just happened are quietly moving their money right now. Silver dropped today, gold dropped today, but here is what nobody is telling you. They didn't drop nearly as much as they should have. Why? China just did something it has never done before in recorded history. A single country moved more silver in 1 month than most nations move in a decade. And while that was happening, the United States seized an Iranian ship, the Strait of Hormuz closed again, and a ceasefire is about to expire. Wednesday. The banks already know what comes next. Their price targets will genuinely surprise you, and one of them is a number most people simply won't believe. Stay with us. Welcome to CSC Alert. Now, before we go any further, if you've been with this channel for a while, you already know we don't do hype here. We do facts, we do strategy, we do clarity. If this is your first time joining us, well, you picked quite a day to show up. We'd like to ask you something, and we're going to ask it the same way you'd ask a wise friend who's been around long enough to know better. Friend, if this information is valuable to you, don't keep it to yourself. Hit that subscribe button. Pass the knowledge on. That's all we ask. Now, we'd also love to know, where in the world are you watching from today? Drop your city or country down in the comments. It always amazes us just how far this community reaches. All right, let's get into it. Something shifted in the metals market on Monday morning. Gold fell, silver fell. But the numbers told a story that most analysts were not prepared for. Silver was sitting at $80.48 an ounce. It was down 92 cents for the day, just over 1%. Gold was trading at $4,110 an ounce, down about $30, which was less than 1%. On the surface, those numbers looked like a bad day for metals investors, but they were not. Here is what made those numbers remarkable. The Strait of Hormuz, one of the most important shipping lanes on the entire planet, had just closed again. The United States blockade was fully back in operation. And just the day before, the U.S. Navy had seized an Iranian cargo ship in the Arabian Sea. In normal times, news like that would have sent gold and silver falling much harder, much faster. That did not happen. Jugan, who closely follows precious metals markets, noted something important that morning. The metals were holding up far better than the headlines suggested they should. When the world is this unstable, and metals are still standing firm, it usually means something bigger is building underneath the surface. Traders were watching the same headlines. Middle East tensions were pushing oil higher. Crude futures climbed nearly $5 in a single session. The dollar was strengthening. Rate bets were turning hawkish again. Every one of those forces traditionally pushes gold and silver down. And yet, silver stayed above $80. Gold stayed above $4,800. Just days earlier, the picture had looked completely different. On Friday of the previous week, gold and silver had rallied sharply. The reason was simple. It looked like the Strait of Hormuz was going to reopen. Headlines celebrated the moment. Investors moved back into risk assets. Metals jumped. Then the weekend arrived, and everything changed again. By Monday morning, the strait was closed, the blockade was reinstated, an Iranian vessel had been intercepted and seized by American forces. The same investors who had celebrated on Friday were now looking at a very different situation. The swing from Friday to Monday told experienced observers something critical. This market is not reacting to news the way it used to. Metals are no longer simply falling when tensions rise and oil goes up. There is a new layer of demand underneath the price. Something structural, something that is absorbing the selling pressure and refusing to let the numbers collapse. That layer has a name, and it lives east of the Suez Canal. Meanwhile, Trump made a statement on Monday that added another dimension to an already complicated picture. He confirmed that the ceasefire, which had been holding fragile tensions together, was set to expire on Wednesday evening. He added that a further extension was, in his words, highly unlikely. That statement landed quietly, but its implications were significant. If the ceasefire expires without renewal, the conflict dynamic in the Middle East escalates to a new level. Oil prices would climb further, the dollar would strengthen, and the short-term pressure on gold and silver would increase. But here's what the market seemed to already understand on Monday morning. Short-term pressure and long-term direction are two completely different things. Traders selling silver because of a stronger dollar are making a one-week decision. The central banks buying gold at the fastest pace this century are making a 10-year decision. The country that just imported more silver in a single month than it ever has in recorded history is making a generational decision. And those generational decisions are what CSC Alert watches most carefully. The metals market in April 2026 is not behaving like a market in panic. It is behaving like a market that is quietly, methodically, repricing itself for a world that looks very different from the one that existed 5 years ago. Gold and silver are falling today, but they are not falling the way they should be. And that gap between what should be happening and what is actually happening is where the real story begins. There's a number that came out of Beijing last week that stopped serious commodity analysts in their tracks. It was not a policy announcement. It was not a military statement, it was a trade figure. And for anyone who understands how silver markets actually work, it was one of the most significant data points of the entire year. China imported more silver in March 2026 than it has in any single month in recorded history. Let that sit for a moment. This was not a modest increase. This was not a seasonal adjustment or a minor statistical blip. The volume that moved into China last month was nearly double the average monthly import figure recorded over the past 10 years. A decade of data, and March 2026 broke every single benchmark in that entire period. Zhugen, who has been tracking Chinese commodity flows for months on CSC alert, had been warning his audience that something like this was coming. The signals were there. The Shanghai premiums were climbing. The arbitrage gap between Eastern and Western silver prices was widening. The pattern was clear to anyone watching carefully enough. Now the data had confirmed it. Bloomberg reported two primary drivers behind the surge. The first was retail demand. Chinese investors, facing a property market that has been struggling for years and a stock market offering limited confidence, turned to silver. Small silver bars became one of the most popular retail investment products in the country. Ordinary citizens were buying silver the same way people in other parts of the world buy gold, as a store of value, as protection, as something real they could hold. The second driver was industrial. China's solar manufacturing sector, which consumes roughly 1/5 of the entire global silver supply every single year, began front-loading its purchases ahead of April 1st. That was the date when export tax rebates on solar panels were scheduled to be removed. Manufacturers accelerated their production timelines, and to produce more solar panels faster, they needed more silver immediately. Both forces arrived at the same moment. The result was historic. But the story did not stop at China's borders. It extended all the way to Hong Kong. The chart that emerged from that data was even more striking than the mainland numbers. When analysts pulled up the Hong Kong silver flow data going back 25 years, what they saw was a market that had completely reversed its direction. For years, Hong Kong had been a net exporter of silver. Metal was flowing out. Then something shifted. And now silver was flowing in at levels that had no historical precedent in that entire 25-year data set. The East was not just buying silver. The East was pulling silver from every direction it could find. This created an opportunity that traders around the world moved quickly to exploit. On the Shanghai Futures Exchange, silver was trading at $90.54 an ounce. At the same time, on the COMEX in New York, paper silver was trading significantly lower. The premium between the two markets had reached nearly $11 per ounce, a gap of 13.67%. That kind of arbitrage gap does not stay open for long without consequences. When silver is worth nearly 14% more in Shanghai than it is in New York, traders will ship physical metal eastward as fast as logistics allow. And that is exactly what began happening. Silver started flowing out of Western vaults through Hong Kong and into China at an accelerating pace. This matters far beyond a simple trading opportunity. What is actually happening is a fundamental shift in where silver price discovery takes place. For decades, New York and London set the price of silver. The COMEX paper market was the reference point for the entire world. That authority is being quietly challenged. When physical silver consistently trades at a significant premium in Shanghai compared to paper silver in New York, the market is sending a message. The price being quoted in the West no longer fully reflects the reality of supply and demand in the world's largest silver-consuming nation. Zhugen had noted on CSC alert several months earlier that Shanghai, Hong Kong, and Beijing were beginning to lead silver price discovery rather than follow it. At the time, some observers were skeptical. The March 2026 import data, combined with a persistent Shanghai premium, suggested that position was correct. Silver was coiling, the spring was tightening, and the pressure building underneath the surface of the metals market was not coming from Wall Street. It was coming from the East. Wednesday was not just another day on the calendar. For global energy markets, for precious